Thank you for viewing this presentation. My name is Brad Renard. I'm the CEO and Chief Investment Officer for MCTO Capital Management. And the title of this presentation is Why It's Time to Sell Passive ETFs and Move Cash Away from Your Investment Advisor, and Why Stock Picking and Active Management Will Outperform in 2019. And the date for this presentation is November 17, 2018. So the questions that we will address in this presentation are the following. Why is this market suddenly acting unhealthy? Is the market's uptrend over? What is the market going to do over the next couple of months? How much will the economy slow in 2019? Because mostly the Fed is raising interest rates aggressively. What will be the best investment strategies in 2019? Passive, for example, buying ETFs or versus active strategies. Should I sell some of my passive ETFs? Should I trust my investment advisor with all of my money? And we'll talk more about this. They usually will just buy passive investments and hold. When is the next recession going to hit? And recessions in general, you usually hit stocks by minus 30 to minus 50%. So we need to talk about that. A little bit about us. I just have a few slides on this, and you can get most of this information off of our website, mctocapitalmanagement.com. We're headquartered in Carlsbad, California. Our team has been managing clients' money since 2005. We specialize in developing long, short, hedged investment strategies that blend technical, fundamental, and quantitative analysis. We manage 4 strategies: the Big Cap Alpha, Contrarian Fund, Sector Rotation, Small Cap Momentum. Our team, and about me, I have a background in physics, a BS in electrical engineering from Columbia University, and an MBA from the University of Chicago Booth School of Business. And if you'd like to read more about our team members, please go to our website at mctocapital.com. Strategies: Big Cap Alpha, focused on strong technicals and fundamentals with stocks with a market cap of greater than 10 billion. Contrarian Fund, that focuses on stocks that have been out of favor for 6 to 12 months and are starting to recover. Sector Rotation, we buy strong stocks within strong industry sectors. It basically follows the money as institutions are rotating money from sector to sector. Small Cap Momentum, we buy stocks with strong momentum with a market cap of 250 billion to 5 billion. And most of our strategies are long short. That is, we make money both up and down. And for the bullish trades, we buy the stock. For the bearish trades, we buy put options on individual stocks. So for more information on these strategies, please visit our website at mctocapital.com. Our differentiation: we do 4 levels of analysis where we blend technical, fundamental, and factor-based quantitative analysis. Our portfolios are long short. We follow strict exit rules, so we're able to let most winners run, but our rules are fast enough to exit quickly to lock in gains and to protect capital. Our portfolios are managed by traders that are nimble and fast-moving, traders that follow exit rules decisively. Our differentiation: more on the 4-level scanner. At the macro level, we do an analysis including technical, breadth, fundamental, and sentiment, and that modulates our levels of bullish and bearish exposure levels. That is, dictating what percentage of our trade should be bullish and what percentage should be bearish, and or sometimes even stepping aside. We then do a technical scan to find high probability setups. We do a fundamental screen. We're finding strong companies for the bullish trades, and we're finding weak companies for the bearish trades. We do a quantitative screen. That's basically statistical econometric mathematics that provides probabilities of the particular trades following through. And then we use technicals to trigger the entries and the exits. So again, our portfolios are long short. We can make money both up and down. We allocate 4 to 5% to each position, and we have strict exit rules. So the rules are fast, but they're still able to let most winners run. And we can usually keep the losses below 5% per position. And that translates to about a 0.25% loss for the portfolio. And we have a hard stop at 8% per position. And that translates to about a 0.4% loss for the portfolio. Okay, let's get into the questions that we initially showed at the beginning of the presentation. And the first question was, why is this market suddenly acting unhealthy? So we have rising interest rates. The yield on the 10-year Treasury has climbed above 3%. China's economy is slowing and is exacerbated by the tariffs. Rising input costs for U.S. companies, and that's from the tariffs. That's causing inflation. The Fed is raising short-term rates aggressively, and that will slow economic growth. We have a flattening yield curve of U.S. Treasuries, and that could be predicting a recession within the next 12 to 15 months. We have a concern that the tax cuts will lose momentum by early 2019. The U.S. deficit is nearing $1 trillion annually from the tax cuts. We have a strong dollar that's putting stress on the U.S. large cap companies and emerging markets. The housing market is demonstrating an imbalance of supply and demand, and the corporate debt markets are sending signals of stress. So all of a sudden, all of these things became a problem in the last 6 weeks. Okay, macro market analysis. So the first thing we want to do is ask ourselves, is the broad stock market still in a confirmed long-term uptrend? And technical analysis at the macro level, at the big picture level, basically focuses on the charts. We're looking at the S&P 500 index, we're looking at the NYSE composite, that's 1,900 stocks, the S&P 400 mid caps, the Russell 2000, that's 2,000 small cap stocks, the Qs, that's 100 tech stocks, and the NASDAQ composite, that has 2,500 stocks in it. So these are the major indexes, and we want to see what the charts look like for these indexes. And here is one that we look at. This is actually a weekly chart. This is the NASDAQ composite. This represents 2,500 stocks, 2018 all the way back to 2000. And each candlestick represents 1 week of trade. And we have the 17-week EMA, exponential moving average, and a 43-week exponential moving average. In general, when the 17 EMA is above the 43 EMA, it tells you that the stock market is in a long-term confirmed uptrend. And whenever the 17 is below the 43, like here, it's telling you that the stock market is in a long-term confirmed downtrend. And we can see that in 2016, pretty much after the election, the market went into a long-term confirmed uptrend, and it went pretty steep. And now it's actually rolling over a little bit. It's getting pretty choppy just in the last 6 weeks. So the 17 is still over the 43 right now, but it is pulling back a little bit. So the chart, as I mentioned, that's shown to the right is the 1743 weekly EMA on the NASDAQ Composite Index. Based on this chart, the market still is in a confirmed long-term uptrend. However, this one I don't like. This is the NYSE Composite. This one has 1,900 stocks in it, and this one looks like the 17 is already starting to cross below the 43. So this is something that we need to watch. Earnings, macro market analysis looking at earnings. This is the S&P 500 index here in blue. This represents forward 4-quarter estimated earnings of all S&P 500 companies, and it's predicting about $173 worth of earnings over the next 4 quarters. So S&P 500 companies are projected to generate $173 of earnings over the next 4 quarters. Corporate earnings growth is strong, coming in at a plus 25% growth for Q3 earnings. Sales growth is strong, coming in plus 9.4% growth. And the negatives that we see is that this level of growth is not sustainable. And fiscal stimulus, tax cuts from the tax cuts will wane over the next couple of quarters. But overall, earnings have been very strong. More macro analysis, economic data. So we have several pages of economic data. And in general, all this data looks pretty good. A few things are rolling over. Real GDP, economy is growing at about 3%. Core retail sales looks pretty good. It's pulling back somewhat, but year over year, we're still growing at plus 4%. Non-defense capital goods, this represents big ticket items that companies buy, and it's been climbing year over year, but it did pull back recently. So this is not looking good, but it could be just noise. You just cannot take this information and just get 1 month's worth of information and try to come to any conclusions. ISM index represents manufacturing, and the health of manufacturing needs to be above 50. Looks pretty strong. Housing starts did roll over a little bit for new homes, but it is still climbing. Consumer sentiment looks good. This was earnings. We already looked at that on another slide. Core inflation's up to 2% year over year, so that's why the Fed is raising rates, because that's about where they want to keep inflation. Light vehicle sales and small trucks is plateauing at 17 million vehicles per year, but it's still very strong. Personal income and spending year over year looks good. Income is money coming into people's pockets. Spending, of course, is how much they're spending, which drives the U.S. economy, and that looks good. Consumer credit looks good. Basically, credit cards and non-revolving loans. The more credit that consumers have, the more that they'll spend, so that looks good. Unemployment rate is excellent. It's all the way down to 3.9%. Now, this actually is a concern for economists, and that's a concern for the Fed, because that drives inflation. That drives wage inflation, and actually that's what we're seeing right here. Hourly earnings, wage inflation is climbing, so the Fed is raising interest rates, trying to slow that down. Initial unemployment claims, how many people are being fired, is just continuously dropping. Non-farm payroll, we've been adding about 150 to 180,000 jobs per month. So this looks very strong. Construction spending looks good, represents about 8% of GDP. It's rolling over, but it looks okay. Industrial production looks fine, and especially when it comes to just manufacturing, the last number was good. This looks fine. Philly Fed represents manufacturing. It is rolling over, but it's still over zero. As long as it stays over zero, it tells you that manufacturing in this region is still expanding. Okay, so that was the economic data, and it looks okay. Okay, macro analysis. Let's look at the indexes. This is the S&P 500 index. This is the daily chart, and this is very choppy. Let's zoom out, give us a better perspective. This was the Trump win right here. Went from 2192, climbed for a year, and then now it's getting very choppy. The easy money has been made. I think we're done with that. Now we're getting very choppy here, and this is still 25% gain from 2192 up to a 2760. Right now I can tell you that the 50 is still over the 200. That's a positive, but it looks like it's going to cross sometime soon. And I see that the index is below the 200-day line. That's not good. We've already had 2 corrections, all within 10 months. That's not good. This was a 12% correction. This was about an 8% correction. Getting pretty toppy and choppy. The positive is I see a higher low, so upward sloping line, higher high, upward sloping line. So the channel is still upward sloping, but it's still a pretty ugly chart. NASDAQ Composite, this has 2,500 stocks in it. Went from 53.47 from the Trump win all the way up to, this is about a 40% increase from here up to about this, where this 50-day line is. The 50-day line is ready to cross the 200, and this index is below the 200-day line. That's not good. The positive is it's upward sloping. That's a higher low. We'll see if this index can get back over its 200-day line. This is the NYSE Composite. This one looks unhealthy. This was the Trump win. This is the breakout, 11,261, climbed up, peaked up here at 13,600, started getting really choppy, took out a lower high and a lower low. Downward sloping channel. I don't like that. The 50 has already crossed through the 200. I don't like that. Right now, the underlying is around 12,400. It is over all of this resistance here. It just needs to get back over the 200-day line. Right now, I don't like the shape of that chart at all. The rut pulled back really hard. This is pretty typical for small caps. Underlying is still below the 200, and the 50 has already crossed through the 200. So most of these charts are pretty ugly. Can they rebound? Yes, and they probably will. But then we have to see where they hit resistance, and that will give us validation if this market is pretty much done going up. Volatility, we're still up in the 20s. The 50 is still over the 200, and it's just telling us that we're not done yet with this pullback. Interest rates, 10-year note. Interest rates are climbing. We just have to get used to it, and the market keeps on throwing a hissy fit because of it. This is the spread between the 2-year and the 10-year note. This is the slope of the yield curve, and it basically says that the slope is getting very flat. That is not good. High yield corporate bonds, as these drop, it tells you that investors want a higher return for corporate bonds, and this is not good. It tells us that the corporate bond market is demonstrating credit stress. Strength of the dollar keeps on climbing, and it's not good if it gets too strong. And it creates problems for emerging markets, creates problems for our large cap companies, makes our products more expensive overseas. And it also tells us that probably Asia's weak, China's weak, Europe is weak. So the dollar is just really strong against a basket of currencies. Here's China, not looking good at all. Some of this is from their own problems, their own internal problems with their economy, and some of it's from the tariffs. EWG represents the Eurozone, doesn't look good. Okay, let's look at a few industry sectors. XLF, these are the financials. Chart doesn't look that great, just took out a lower low. All of these charts, this index, these need to get back over the 200-day line. And the 50 right now is below the 200-day line. This needs to change here, or this is not going to be good for our stock market. Technology, it looks a little better. Upward sloping channel still. This will probably get back over the 200-day line, and my guess is most of this will grind back up to the highs by the end of December into January. Industrials took out a lower low. Don't like that. Right now it is finding support near these lows here. Here's the high double top. Doesn't look good. All these charts need to get back over the 200-day line. Transport, same thing. And transport's a leading indicator. Rail, air, trucks, they all transport goods around the country, and it's a leading indicator for the US economy. And it took out a lower low. It did find support here. That's a positive, but it doesn't look good. Market breadth. This is the advanced decline line, cumulative advanced decline line on the S&P 1500. And to learn more about this, just go ahead and you can type this into Google, cumulative advanced decline line. And it looks okay. It's trying to recover, but we'll see what happens. This needs to get back over this line up here. So if this can take out a higher high right here, then I'll feel much more comfortable with this market. If this thing starts breaking down, then this market's going lower. S&P 500 cumulative advanced decline line. This one looks a little better. I have some moving averages on here. I have a 20 and a 50 EMA moving average, and the 20 is back above the 50, so that's a good thing. This has to get back over this high right here. If not, if it starts breaking down, then this market is going lower. Okay, to the questions that we showed at the very beginning of this presentation. Why is this market suddenly acting unhealthy? Well, we already discussed that. What is the market going to do over the next couple of months? Is the market's uptrend over? How much will the economy slow in 2019? Should I sell some of my passive ETFs? Should I trust my investment advisor with all of my money? What will the best investment strategies be for 2019? When is the next recession going to hit? Okay, let's answer these. From what we just looked at, what's the market going to do over the next couple of months? Well, through early December, it's probably going to trade sideways and choppy. The G20 meeting is on November 30th. That's when President Trump meets with the Chinese president, and they're going to talk about the tariffs. We're also waiting on the Mueller Russian investigation. It seems like something is going to happen before Christmas. Definitely before the G20 meeting, this market's not going to do much. And if we do see any breakouts and any stocks that are looking good, I don't trust them right now. I don't think we're going to be getting into any trades before the November 30th G20 meeting. There's too much risk there. Is the market's uptrend over? We won't know until late December through March. So if the SPX will probably grind back up to 28.75. That was the January high. But if it can't break over this level by March of 2019, then the uptrend is most likely over. And in general, the market's going to be a lot more difficult to navigate. How much will the economy slow in 2019? Well, because the Fed is raising interest rates aggressively, the U.S. economy will most likely slow down through 2019, and this will slow corporate earnings, and corporate earnings ultimately drive stock prices. Should I sell some of my passive ETFs? Yes, it's time to sell or reduce exposure to passive investments. We can't hide in treasuries or corporate bonds either because interest rates are rising. So either one thing is go to cash. Cash is good. For those who want to put money to work, it's best to be in actively managed long-short strategies that stock pick. And that's what we do. More questions? Should I trust my investment advisor with all of my money? Well, here's the problem with investment advisors. They usually just buy the market. They purchase passive ETFs. They're not chart technicians. They don't have strict exit rules. They're not trained to exit positions quickly. They're not traders. They're not portfolio managers. Their job is to just stay long the market so they can hold on to your assets. They do well when the market trends up, and like it did since the Trump win in November 2016. But the easy money is over. And unfortunately, most advisors will hold right through a recession and say, it's best just to hold as it will eventually come back. Well, that's never a good thing to do. We know how that played out in 2008 when most accounts lost 40 to 60% of their value. What will be the best investment strategies for 2019? Well, the easy money with passive ETFs is over. Time to reduce exposure or sell those completely and go to cash. And active long-short strategies with stock picking should outperform. So long-short strategies with strict exit rules can make money in both directions and can protect your capital. Last question, when is the next recession going to hit? Most likely in 2020. As the Fed continues to raise rates and choke off economic growth. And it happens over and over and over again. That's what the Fed does. They will continue to raise rates to keep inflation under control until they finally push the economy into a recession. Recessions usually hit stocks by minus 40 to minus 50%. The stock market is forward-looking by 6 to 9 months, so the market could get highly volatile sometime in 2019 as investors anticipate a recession in 2020. Okay, that's the end of the presentation. Thank you very much for your time. And if you want more information on our firm and our strategies, please go to mctocapital.com. My email is brad@mctocapital.com. And our toll-free number is 877-248-7455. Have a good day. Thank you.